Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is episode 114, Bonds versus Stocks. Okay, welcome back to the show. We hope all of you out there are staying safe and healthy during this horrible pandemic. Quick shout out, if you are listening to this on your favorite podcast platform, I do certainly appreciate it. If you want to give a thumbs up, if you're watching this on YouTube, thank you so much. Thumbs up on there as well would be greatly appreciated. We are out there producing content on a weekly basis, so please be sure to subscribe so you don't miss another episode of Upticks. For today's topic, I wanted to talk about bonds versus stocks. Many people are infatuated by the stock market. It's the sexy part of finance. This is where you see the charts, the ticker symbols going up and down, volatility. You hear of stocks going way up or going way down. But bonds often get ignored. And bonds, in our opinion, at Falcon Wealth Advisors, play a very important role in a well-diversified portfolio. And a lot of people don't even know what a bond is. And so I wanted to define that here for you. Simply put, a bond can be thought of as a loan investment. So when you buy a stock, you are transferring your capital in return of shares of ownership in a company. However, when you buy a bond, rather than owning a company outright, you are in fact loaning that company money. Now, in return, rather than exchange ownership, they pay you interest. So you say, hey, this company is issuing a bond, meaning they're raising capital so that they can hire employees or buy another company or improve their process, whatever that may be. And when you do that, they pay you an interest payment, 3, 4, 5%, whatever it is. And then after a predetermined, typically, time frame, you get your return of capital paid back to you. So if you have $10,000, you give it to a company, they pay you 3% interest, let's say every year. And after 5 or 10 years, you get your $10,000 back. So you loaned the money versus bought ownership. Now, because you're only loaning an entity money, the risk isn't as high. And that's why the bond market typically, in most circumstances, not all, is considered a safer investment vehicle because you aren't taking that ownership risk. But there's a caveat to that. Since you're not taking the risk, you also typically don't get the reward. So if the stock shoots up, that doesn't mean that your bond is going to shoot up and be worth more. Right? You made a loan. You don't own the company. Bonds, by their nature, again, dampen volatility against the stock market. And that's why we buy them for our clients. When people panic in the market, not our clients, right, at Falcon Wealth Advisors, but when other investors panic, they typically sell from their stocks and they go buy bonds, which drives the price of bonds higher. And many times, in times of panic, we are actually selling our bonds because their value has been driven up, and we sell bonds and we go buy stocks. But I don't, the title of this episode was a little bit of a teaser. I don't want you to think it's either or. Because in my opinion, for a properly diversified portfolio, both of them may make sense. So it may make sense to have a certain allocation to stocks and a certain allocation to bonds. And the idea is they blend together because they behave differently during different economic events. Typically when things are bad, not always, but typically bonds will go up. And when things are good, doesn't mean they'll go down, but they typically don't grow as fast as stocks. And so what's beautiful is that if you do have both in your portfolio, when one is up or down, stocks or bonds, bonds or stocks, you can sell the other one and go buy the other one. So you're always able to adjust and adapt based on what's happening in the economic environment, which I think is very important, especially for a retiree. Right? If you're entering into retirement, if you're 5, 10 years away, You want to have that dry powder that you can buy or sell when another asset class is doing something differently. What that allows for is a much smoother retirement portfolio and trajectory on your capital. You don't want it going all over the place in retirement. You know, if the Dow goes down 500 points and you have to call me and say, Jake, can I go buy milk? That's no way to live. When that happens, because it does, when the Dow goes down 500 points, our clients know they have bonds and they pull from their bonds. When the stock and the Dow's up 500 points, well, then they're probably pulling from stocks. So that's why it's so important that you have, especially for a retiree, an allocation, in our opinion, to both in your portfolio. Now, there is one huge issue, though, I do want to point out. As it stands now, leading into the fourth quarter of 2020, it's very difficult to get much return from bonds. Why is that? Well, the Federal Reserve lowered interest rates, and when that happens, bond prices go up, but their interest payments for new bonds goes down. And so as of the recording of this episode, a 10-year Treasury bond from the United States government is only going to pay you less than 1%, right? And that's tough, right? So you don't get much return for that. So what we do at Falcon Wealth Advisors is that we buy all different types of bonds, right? We might buy corporate bonds, which are issued by companies. We might buy municipal bonds, which are issued by municipalities or governments. We'll buy treasury bonds that are, initiated by the federal government. And we'll buy also something called a preferred stock, which isn't quite a bond. It's also not quite a stock. It sits in the middle. And maybe that's a topic for another episode. And then we'll also even look at dividend paying stocks or trading options. So there's all these different avenues we can get. And again, I'm getting a little off topic because I wanted to stay on bonds here. But my point is bonds still make up a piece of the portfolio for most all of our clients. But if they are yielding something very low, that doesn't mean there's other things that we can't do around the bond portfolio to keep that diversifier in there while also generating some income. And this is why it's so very important, in my opinion, to not be using investment products. You've heard me talk about this before on our show. We don't like annuities. We don't like mutual funds. We don't like index funds at Falcon Wealth Advisors because you lose this ability, in our opinion, to customize, control, keep your costs or your fees down when you go and outsource to these third-party money managers, right? And they don't typically know the end client. They're just managing a pool of money, and they don't have these one-on-one conversations that we do at Falcon Wealth Advisors with our clients to talk about their bonds, talk about their stocks, talk about their goals, their financial plan, their retirement, right? So again, I caution you, if you are invested in a third-party product and you're working with an advisor, I'd be very careful. Especially, I'd be very careful on how that fee is being charged, right? So you want to be careful of that. All right, so hopefully that gives you a little bit of knowledge around the way bonds versus stocks work. They don't always zig and zag, but they do offer diversification. So when you put them in there together, because one is an ownership vehicle, that'd be a stock, and one is a loan, that'd be a bond, they are different, and we like that in the portfolio. That's very important, especially for a retiree. Okay, very good. So that's all the time that I do have for you today. Please, I'm out there on social media if you want to follow me or become a friend on Facebook. I'm out there on Facebook, Instagram, Twitter, and LinkedIn. Also, Falcon Wealth Advisors has a great social media presence. If you want to see our company's content being distributed, please feel free to like us on Facebook, Instagram, Twitter, and LinkedIn as well. I do also want to give a quick shout out to my business partners, Corey Bittner. He has a podcast of his own called In the Money Insight, which has the worst podcast music I've probably ever heard. He says his clients love it. I disagree, but he has some really good content if you can get through the horrible intro music. My other colleague, James Lewis, has his own podcast called Financial Philosophy. James has been taking a very deep dive into pensions. So if you work at a company that has a pension, I highly encourage you to go check out Financial Philosophy by James Lewis. He's got a ton of content. He's got blogs and podcasts where he's researched that topic extensively. Corey's I kind of skipped over. Corey's is more like mine. He does have timely topics that he talks about, typically a retirement planning as well. So it's good. So again, we've got a lot of content coming out of Falcon Wealth Advisors. It's organic. So again, it's not coming from some corporate office in New York. It's curated right here in Kansas City, and we brainstorm ideas and deliver that content to all of you out there listening. So again, hope all of you out there are staying safe and healthy. That is all the time that I have for you today. Thank you again, and we hope you have a great week.